Hi, folks. This is Mike Zlotnik, Big Mike. This is a short executive summary video for the updates that we put together in a written format. So first of all, the disclaimer, please read the written disclaimer in the written updates. I'm just going to discuss sort of some key points of Q1 performance, as well as some of the Q2 information and up-to-date points and news. Although the fund takes a while to compile previous quarters data, so we don't have Q2 results. We're certainly recording this in August, late second half of August 2023. So discussing just the Q1 feels a little strange, but because of the change of format from going the hourly investor update calls to shorter 10-15 minutes video, as I'm recording right now, and the written update, that's the format that we're changing. So let me just kind of go through some of the updates in Tempo Opportunity Fund and kind of my perception, how the fund is doing, where things are going, and so on. So appreciate your time and attention in advance. First of all, Q1 wasn't terribly exciting quarter. It was sort of one of these steady Eddie quarters. We reported results in the distributable income in a low to mid 7% annual range, and unrealized gains, which is appreciation, was sort of flat, or we basically are taking a very conservative position in writing up assets. So what does it mean? So Tempo Opportunity Fund, just a reminder or refresher, is an open-ended fund, and we basically do quarterly what is known as a mark-to-market or stated value methodology. We look at all our assets in the portfolio, and we try to determine should we mark it up, write it up, or write it down and give an asset, depending on its performance. Why it's important? Well, that's what creates appreciation or unrealized gains, and that's what makes you feel as if your portfolio values appreciate. But at the end of the day, it's not increasing cash position. It's just used for the computation of net asset value for people who are redeeming or for people who are subscribing. So we're taking a very conservative position in that front because the environment is uncertain. What has transpired in 2023 is that transaction volume has fallen substantially relative to 2022. So there are few transactions to measure against what these values are. So from our perspective, we're just being very conservative. If there isn't enough really good news on a project, we're just not marking it up. And if the project has possibilities of falling in value, we will mark it down. So we're just taking cautious approach. How does it really impact you? In a matter of speaking, by having portfolio valued more conservatively, it's got a lot of sort of, I call it delayed gratification. When these projects come to an exit point, they'll often come with a positive surprise. Of course, there are no guarantees, but we're trying to make sure when they come forward and they exit, we would much rather see positive surprise instead of a negative surprise. So this is what we've been doing, and we're already beginning to see some of these positive surprises coming through in the news, so I'll provide some updates. So again, results of Q1 were not terribly exciting. Q2, we expect distributions to be more or less in the same range. The reason for this is that nothing substantial transpired. Nothing really sold, nothing super exciting took place in Q2 that would justify an increase in distributions. So for the time being, again, until CPAs complete their work, and we use Verivest, as you know, we are just not expecting anything outside of that 7.5, maybe up to 8% annual distribution range. I know it's not terribly exciting, but at the same time, this fund is not designed for a lot of excitement. It's designed for steady Eddie kind of environment. And we still believe that the fund on a long-term basis will generate 10 to 13% annual target return. We're just in a period of a little bit higher uncertainty. So if we're generating realized returns, distributions in the 7 to 8%, we feel fairly, I wouldn't call it happy, but fairly content with the results. But some positive news are beginning to come out. And one of the positive news is that we learned that Alafaya Commons is a shopping plaza in Orlando, Florida, is hitting an exit point with pretty strong results. So we're really delighted to see that. It is retail sector. It's with a group that we've worked with for a long time. We continue to work with them quite a bit. They are specialists in the open air shopping, LBX, and to our surprise, it's exiting. So it's going to generate increased distributions for Q3. It is likely to exit at some point Q3. They're under contract to sell. So we will take a look at the actual results when they come out and make a decision what happens on the unrealized gains for Q2. But the realized essentially cash when it comes in, is expected towards the end of Q3, and we will distribute at the end of Q3 when we close the books in Q3. So Q3 distribution is generally expected to be improved from this sort of boring 7 to 8% range. To what level? Again, I don't want to speculate, but whenever we have a sale event, usually bump things up meaningfully. So that's that. A couple of other developments. So Kingston is an office space that we wrote down to zero. So in the books, that asset is sitting at zero. Any recovery we have from that asset will be positive development. So there's some positive news that the asset hasn't sold, but the bank doesn't want to foreclose, doesn't want to take the asset. So they are effectively granting forbearance, and they're moving towards forbearance agreement. They haven't granted it yet. And that gives us some hope over time, although it's office space and that asset class has been sort of depressed with COVID. So again, we haven't written anything up, just at least the good news is that the bank doesn't want to take the asset and they are working with us. Another quick update is that the industrial portfolio we have on the Butler Drive is doing really well, continues to get strong cash flows. So that sector is just performing well. Another really interesting development, which is not even in the written update, is that another shopping plaza called New Iberia, which we wrote down to zero as well, is beginning to perform, and we just heard we're getting distribution for the first time in a number of years. So after COVID, it suspended distributions, it was struggling, and now it's beginning to cash flow again. And because I've written it down to zero, we have nothing but the upside in that deal. So we'll probably cautiously start writing it up. So it's sort of a delayed gratification that's beginning to come forward as things begin to improve. We'll continue to share those news with you. And overall, the fund is very well diversified, as you can see from the reports. We have capital spread across many investments, many asset classes, many locations all over the United States. It's doing what it's supposed to do. It's supposed to be a broadly diversified fund with over 50 assets, maintaining kind of steady Eddie performance with pretty good predictability. Majority of the fund is performing. So we call these assets either performing, underperforming, or distressed. So per the data, as you can see in the written updates, 92% is performing, and then the remaining 8%, some of it underperforming. We actually cleared out some of the distress files, so we feel pretty good about that. And any fund of this size needs to have hopefully some great news, but there's going to be some challenging news. So if there's 8% of underperformance, it doesn't mean those are distress files. They're just underperforming their pro forma, which is normal and typical. So overall, it is part of the strategy. It's part of overall investment thesis. When we project returns at 15%, in our head, we always allocate some loss reserves and some underperformance. So it is part of the game. Overall, again, fund target 10 to 13%. When we write these checks, we generally write them with return targets substantially higher. Also, this report shows compilation of some of the exits that we have completed over many years, and that gives you a little bit of historic data to see how tempo full cycle projects have done. And this specific table shows you kind of returns we've achieved as part of this investment strategy. So it gives you an idea. Some of the deals underwritten, some of them are debt, some are equity. So debt deals generally are not targeted to generate 20% IRRs. That 12, 15% is normal for that because it's interest rate and it usually has seniority over equity. And some projects generate much stronger returns because the equity positions. So again, on average, the fund seeks to generate target returns before risk adjustment somewhere in the mid to high teens. And after adjusting for risk, our target return to investors is 10 to 13%. So again, conservative underwriting, generally broad diversification. These are the strengths of the fund. And the history of transactions that have gone full life cycle demonstrates that. So we feel strongly about the fund mission, the fund portfolio, what we are doing with the fund. It's, as I said, broad diversification. In addition, you can actually see full mix of current assets as part of the report. So we're trying to increase transparency, give you visibility what kind of assets are in the fund. Happy to answer follow-up questions. The fund is still our flagship fund in the mixed growth and income strategy. Fund was started in 2017, continues to be very steady Eddie in what we do. And some of its growth projects continue to provide delayed gratification. When they come to an exit point, hopefully we will see some positive surprises and we'll be happy to share. So fund is still open to investment. It is current environment is fairly slow on new capital deployment as well as on exits. So folks who are looking for a steady type of 2/3 income at 1/3 growth type of investment, this fund becomes an interesting consideration. Obviously, consult with your attorney, CPA professional, your financial planner, to make sure it fits well into what you're trying to accomplish. So I appreciate your time and attention. Feel free to ask further questions through a few different means. You can reach out to Diana. You can email invest@tempafunding.com, which goes to Diana, it goes to me, it goes to a few other folks, and we'll be as responsive as we can. And we appreciate your investment, appreciate your support, and would love to hear back from you. Thank you kindly.